the vast majority of the high profile deals that are out there that we talk about are like upper market lenders, and the large asset managers that raise funds are raising billions and billions of dollars that they have to find a home for. And they're not doing
Mm-hmm.
that in $2 million loan sizes or $4 million. But the number of companies that would be seeking capital in private markets in those numbers is small. So those really big firms are chasing a small number of deals that would actually qualify to put money to work. But as you get down market, and this is where I think it gets interesting, no one talks about this. Everybody talks about so
Mm-hmm.
much money in private market. Look at how much Aries raised or whoever, right? And look how much money that they put to work in private credit. But they're really talking about an area of private credit where most private credit transactions don't occur. They occur
Mm-hmm.
much farther down. It's the companies that are like your bakery on the corner or the small business like service provider, the local gym provider, or startup environments. Those are the folks that are largely going into these markets because the banks don't really lend. SBA loans take forever. And
Mm-hmm.
they might have an urgent need for capital. So they're going to these private credit lenders to get deals done
Mm-hmm.
quickly and at these smaller sizes. But most people don't realize that the vast majority of the businesses in the US economy fall in that bucket. There's like 75% of all the business in the US are small businesses. It's the 25% that's being chased by these really big funds and these big operators.
Mm-hmm.
Where do you play? What's your thought process on where the opportunity stands today?
Mm-hmm. Right. So great point. So let me kind of paint you a picture in terms of how we think about it. So, for example, most, if not all of our managers in our fund of fund vehicles are niche
Mhm.
managers for those exact reasons that you described, right? Number one, they're prior operators in the very verticals that they're lending to. But number two, they understand that there's a lot more demand in that space for 5, 10, 25, $50 million loans, right? All the managers that we've selected, we're talking about fund sizes sub 500 million,
Mhm.
right? Where they have no problems deploying capital. Right. Another manager that we love, that's actually our anchor manager for our second vehicle, they're a specialty private credit fund that focuses on innovative healthcare lending,
Mhm.
right? So they make senior secured loans, first lien, to innovative commercial stage businesses addressing unmet needs in healthcare, like improving patient outcomes, lowering costs, increasing access to care. And to be clear, they only invest in commercial stage businesses, right? So eliminating the binary risk that's typically associated with clinical stage
Mhm.
companies, right?
Right.
And this is a business model that has worked extremely well for them over the last 10 plus years. And again, they're also in a prior life, they were prior operators in this kind of healthcare, in the healthcare space. And they're able to kind of structure very unique warrant packages attached to their loan packages such that total returns, right, are in the low to mid teens on a net basis,
Mhm.
right? So again, very different from your B2B SaaS vertical, but also similar in that it's a vertical, right? That's the only one that they're focused on, where they're targeting EBITDA levels of 25 to 100 million annualized, right?
Mhm.
And again, it may sound small, but in fact, it's not at all. They have no problems whatsoever filtering for companies to lend to, right? And I think what you mentioned a few minutes ago, the problems with the areas of the world is that they have a lot of capital to deploy. It's a waste of time for them to do it in piecemeal 10, 15, $20 million segments. They're only looking probably at $100 million plus deals,
Mhm.
right? You're talking about a much smaller subset. And that's a problem that we don't want our managers to have
Right. You
at
also
the end
have
of the
to
day.
broaden. Like, you can't be niche anymore at that point. Because if you're niche,
Yes.
let's use the example of like dental clinics, right? Like, there's a
Hmm.
million dental offices in your local area. It's probably
Hmm.
150 within 5 miles of your house, right? So if you're a niche manager that only lends to dental clinics in the northern suburbs of Chicago, you got thousands of potential fish in that pond.
Hmm.
But
Hmm.
if you're gonna do dental clinics, but you gotta put $100 million to work, then you gotta expand to a national level, and then you gotta expand to only these very largest practices which means you probably only have like 100 potential companies that could need you, and only maybe 20 of those companies that actually have a need for capital at this time. And then
Mhm.
now you, Aries, are competing for the business of those 20 with Blackstone and KKR and Apollo. And so now they have a lot of managers, but a small subset. And that's like the worst scenario you have. Whenever you're dealing with lending, you want to have a very large pool of people who need capital and a very
Right.
small pool of people you're competing with to give capital. So,
Right.
to your point, you got to think about those subsets and those niches. And like the more you have to lend, the bigger the pond of verticals there are. You can't be just a SaaS. You can't just be a dental clinic lender. You have to be
Mhm.
broader because of that, right?
Yeah, exactly.